Dear students, good evening. Yesterday we have discussed about the depreciation. The same topic we will continue today. But today we will discuss the new method of depreciation, that is the declining balance method. So we are taking the same example that the company or the business has purchased a fixed asset, a non-current asset, which is a tangible asset, which is a car. The business has purchased a car for 25,000. And the expected life of that asset is how much? That is 5 years, and they paid a cash. They purchased the car on the cash basis. So today we will discuss the declining balance method. Yesterday we have discussed the straight line method in our examples, where the depreciation is same every year. So considering the salvage value, without salvage value. Today we will discuss the declining balance method, or there is some other option in that. This is the double declining balance. Now there are two options, two alternatives in the declining balance method: simply the declining balance method or the double declining. But normally the double declining method is used in the calculation of depreciation. So in that, the percentage may be normally given in the question, or if it is not given, we have a simple formula that 100 divided by the life. 100 is the percentage and this is the life. So 5-year life, for example, so it means almost 20% is the depreciation rate. So this will give you the rate of the depreciation, or the rate of the percentage, how it will be calculated. So we assumed like 100 divided by 5. 5 is the life of the asset, so it is almost 20%. So we are considering three different options. The first one, we have that we are depreciating it on 20%, or if the percentage is given, for example, it is 30% depreciation, or this is the double declining balance method, where we have a 20% normal depreciation, but we are considering the double declining balance method, so it will be 40%. Only the percentages are different, but the calculation method is same for all. So the entry, the basic entry, the vehicle, the car account is debit, and the cash account is credit by 25,000. So this is the same entry for all the method, the very basic entry when the asset is purchased with a life of the 5 years. Now the second thing that we have to consider, for year 2, year 3, year 4, year 5, all the depreciation will be calculated. So if we are using the first method, 25,000 multiplied by 20%, very simple, the depreciation will be 5,000. But if we are using the double declining balance method, so 25,000 multiplied by 40%, it will be 10,000. Or if it is a 30%, it will be 7,500. Only the amount will be different in the different methods of depreciation. The entry will be same. Depreciation expense of car will be debit, and the accumulated depreciation car will be credit. So here we have, for example, we are using the double declining balance method, so it will be 10,000. So depreciation expense will be debit, accumulated depreciation will be credit. Now there is a small change. What is that? In the straight line method, we have a same amount of the depreciation every year, and that depreciation is calculated on the base of the cost of the asset. So 25,000, for example, 30%, so it will be same 75, 75, 75, or 20%, so it will be same every year. But here we are considering the declining balance method or double declining. What we have to do, first we have to calculate the net book value. So the net book value at the start of the second year, it will be 25,000 is the cost minus depreciation. So 25,000 minus 10,000, so it is almost 15,000. So now we have to multiply this 40%. So the answer is 6,000. So the depreciation for the next year will be 6,000. So if you notice, the first year depreciation was 10,000. The second year depreciation is 6,000. In the same way, every year the depreciation will be reducing. So that's why it is called as the declining balance method, where every year the asset depreciation is declining, and every year it will be less as compared to the previous year. So it depends that which type you are using, or if it is a 20%, so we have a net book value, 25,000 is the cost, first year depreciation 5,000. So it is 20,000 multiplied by 20%. So it will be 4,000 for the second year. So in that 20%, 5,000 is depreciation for first year, 4,000 is the depreciation for second year. Again here, if we are using only 20%, so the depreciation is less as compared to the previous year. And the same in the 30%, like the first year depreciation was 7,500. Then the net book value at the start of the second year is 17,500. So if we depreciate by 30%, so it is 5,250. Only difference is that the percentage, otherwise the method will be same. We are not calculating the depreciation on the cost. We are calculating the depreciation on the net book value. And for example, for the next year, let's say if it is a 40%, so the net book value for the next year will be, we have a 15,000 minus 6,000. So the value, the net book value for the year 3 is how much? It is 9,000. So multiplied by 40%. So next year depreciation will be 3,600. So first year depreciation 10,000. Second year it is how much? It is 6,000. And the third year it is 3,600. So the entry will be same here. So on the 31st of December 2022, so depreciation expense debit and accumulated depreciation credit, it will be 3,600. So every year the depreciation is reducing. That's why it is called the declining balance method or reducing balance method, or here we are using the double declining balance method. I hope you have understood the concept of that. The entries are same, only difference will be in the calculation or in the value of the depreciation every year. The net book value is calculated in the same way. That is how it is calculated. That is cost minus accumulated depreciation. I hope you have understood the concept. Thank you.